Welcome back to More Fun with Finance. I'm Dr. William Elliott, and I'm coming to you from my studio in beautiful uptown Shaker Heights. This lecture is about credit and inventory management. Fairly short little chapter, not a lot of deep topics, so we won't spend a ton of time on it. A lot of this you should be able to glean out of the reading, but with that said, there are a couple of things that we should talk about, in particular some of the models that are described in there. The EOQ might not make a lot of sense, and some of the math may be confusing, so we'll spend a little bit more time going over that. All right, so let's get to the lecture. I will get out of the way here. Okay, so here we are with the slides. Chapter outline. All right, so first thing off, we're going to be talking about credit and credit analysis. Why grant credit? Well, I mean, certainly the most obvious reason, maybe we can increase our sales. Somebody who couldn't buy it with cash might still be able to buy it with credit, and if at the margin we're still making money despite some of the additional costs, we should go ahead and do it. And some of the additional costs are bad debts. If somebody orders from us and then never pays, and they keep the product, then obviously that's a cost to us. Now, it's not the full retail price, but there's still a cost there. We also have to somehow finance those assets that we have sold and didn't receive cash for immediately. So we've got a period of time over which we have to finance those. So we're looking at a trade-off between these items. You know, how much extra do we get from the sales versus how much does it cost? We have some terms of the sale. So that would be, how long do we extend the credit for? Is this a 30-day thing, or are we talking about months or more? How much or if any, do we give for a cash discount? This is something that you'll see the terms as something like 210 net 30 is a very common use when you're selling goods to another company. So their accounts payable come in, and they can either save 2% if they pay within 10 days, or they're required to pay the full amount in 30 days. And we'll talk a little bit about figuring out what that interest cost actually amounts to. If you don't take those sorts of discounts, you're really paying a very high rate for that extra 20 days of financing. And then what type of credit instrument is it? Is it on the basis of just a handshake and an agreement between two businesses? Is there some sort of credit agreement or document that guides all of this? We're looking for some means of doing this, and this process is known as credit analysis, and we'll talk a little bit more about that. And then lastly, how do we collect on these debts that are owed to us? That also is a costly part of this process and is something that we need to take into account when we consider the costs of granting credit. If you'll remember back to when we were talking about the operating cycle, you'll remember, I hope, the accounts receivable portion of that. That's from the point of time at which we actually sell our items and they are shipped out to the point at which we actually receive and have use of the cash from that sales. Now, the customer, the buyer, will have mailed a check, and then once we actually get it, that period of time is known as the cash collection period. As I mentioned earlier, something like 210 net 30, or in this case, actually they're talking about a 210 net 45, means that you get a 2% discount off of the face value, the stated value, if you pay within 10 days, but you must pay the entire amount within 45 days if you don't take advantage of that discount. Now, for instance, when we're talking about something where we've got a $500 purchase, the amount that we would pay if we took the 2% is only $490. Now, that may seem like a trivial amount, but we're going to see just how much that adds up to, because remember, that 2% that we're getting off only is a discount only if we pay within the 10 days, and then we still have to pay in 45 days no matter what. So we're basically paying 2% for 35 days worth of credit. Now, when we look at that on an annual basis, that's quite oppressive. And in fact, it gets even worse than what it might appear, because that 2% is not on the entire 100, it's on 98% of the purchase. So in fact, it actually comes out to be a 2.04% rate that we're paying over the course of a 35-day period. And if we annualize that using an effective annual return formula, as we have right here, we find that we are actually paying 23.45%. By the way, let's see, this should be equal sign here, and this is -1, and another equal sign there. All right, so what's the credit policy do for us? From a revenue perspective, we do have a delay in receiving cash. And in fact, we may have some customers who might have otherwise been cash customers who turn into credit customers. So that could be a potential loss there. However, we may be able to increase the price because obviously they're getting something extra rather than just the product or the service. They're getting credit as well, and that's costly. We either increase the price of that or we give a discount to those who pay cash. Either way, it amounts to the same thing. And then ideally, this credit policy will hopefully increase sales. So we're hoping for that sort of thing. Now, from a cost perspective, the cost of sales still are incurred whether we get cash right away or whether we extend credit and we don't get cash for a month, possibly 2 months. So we have to somehow finance these receivables. Remember, receivables are part of your net working capital, right? They are a current asset, and as such, they must be supported with something. Typically, we want to support short-term assets with short-term debt. So we're going to be financing that at a short-term rate. Now, in normal interest rate environment, we would expect that to be a relatively lower rate compared to, say, longer-term rates. But in periods of time like we've seen recently, sometimes short-term rates are equal to or even higher than long-term rates. So certainly the cost of this is something to think about. We also have probability of non-payment. This would be known as bad debts, and we have to take account of that. Now, it doesn't cost us the entire amount. It simply costs us what we have in it, but still, it's a bad debt, and it's something we have to account for. Some percentage of our credit customers will end up not paying us, and or it's going to be more costly to collect from some of them if we have to take them into a longer process of collections and actually factoring these bad debts off to another company. All right, so suppose here we have a company that's considering switching from cash only to a net 30-day policy. We have the price per unit. This is the retail price is $100. We have $40 of variable costs. The company currently sells 1,000 units per month, and this proposed credit policy is hoped to increase that by 50 units per month. So we would go up to 1,050 units. The required rate of return on this project, so we're thinking about this as a project. The required rate of return is 1.5% per month. And now this isn't necessarily the same rate that we would use to evaluate a normal project for the company because it has a different risk than the projects that the company engages in normally. It's normal operations, the products that we produce. This is a financing product. This is not the product that we produce or the service that we provide. So this could be different from your weighted average cost of capital. In this case, we're told that about 1.5% per month is what we're expecting. All right, so we want to figure out both what is the NPV of this, and then should we actually engage in that project. Obviously, if the NPV is positive, then we should engage in the project. So once we answer the first question, the second question should become very obvious. Now, let's figure up our incremental cash flows here. So we have $60, and that is the marginal profit, or that is the profit. If we have variable costs of $40 and we sell the item for $100, that's a $60 profit, and we have an increase of 50 units, so that gives us a total incremental cash flow of an extra $3,000. If we assume that is a perpetuity, and in this case the perpetuity would be on a monthly basis, then we can use this formula right here to evaluate the value of that perpetuity. So an extra $3,000 per month at a risk rate of 1.5% gives us $200,000. All right, so obviously that seems like it's a pretty good deal. Now we have to figure out the cost piece of that, and we subtract the costs off of the present value of the incremental cash inflow, or the benefit, if you will. So the costs are $100 times the 1,000 units, plus an additional $40 times those extra 50 units, gives us a total cost of $102,000. We subtract that from our present value, and we get an NPV of, oops, my pen has stopped working, an NPV of 98,000 here. So yes, the decision is we should take on this project. And that's because we have a positive NPV, quite a substantial positive NPV. That cost, this 1.5%, has already factored in the potential for bad debt and collections, et cetera, et cetera. So that's how we manage that piece of it. Is in that risk adjustment. All right. So optimal policies, total costs of granting credit are both carrying costs and shortage costs. So we've got required return on our receivables, we've got losses from bad debts, and we have costs of managing credit and collections. So we need to have some sort of positive return from our receivables, obviously. And in the case of the extra sales in the example that we just looked at, that was $60 extra. The losses from bad debts and the costs of managing credit and collections are actually factored into that denominator in that present value, if you will. It's this, clean this up. It's this piece of it right here. That's factoring in those bad debts and the cost of granting credit and then collections. If we have lost sales due to a restrictive credit policy, that's a potential problem, right? We want to have a credit policy that is flexible enough that we make all of the sales possible while still minimizing the bad debts and the amount of costs that we dedicate to collections. Total cost is the sum of the carrying costs and the shortage costs. And if we look at this chart here, this really kind of lays it out quite nicely for us. Where these two lines cross, the carrying costs are increasing in the amount of debt, right? So more credit that we grant means that we have to finance more receivables. We potentially have more bad debts, and we potentially incur more costs of collecting. And so those are increasing in credit. The opportunity costs are decreasing in credit. So the ability to increase sales in particular are opportunity costs. So if we have very restrictive credit, then we don't get that bump in sales. If we have less restrictive credit or more flexible credit, then those costs go down. Where they meet is the minimum right up here. And so that's where we want to be. That's the amount of credit that we want to grant, is where those two lines cross, where the opportunity costs and the carrying costs are equal to one another. How do we decide who gets credit, who doesn't get credit? Multiple ways you could go about it. You could get pretty sophisticated and do something like a credit ranking, the 5 C's of credit. We'll look at those in just a minute. Or you could simply look at your customer base. You know, if it's a B2B, it might be a little bit easier if you have relatively few customers. They've been longtime customers. Probably don't need to worry too much about those. But if you're selling to thousands of retail customers, potentially, then you want to use some sort of credit scoring method. And it may not even be in-house. It may be that you go out and get a FICO score of some sort in order to assess that. And you pick a level of that FICO score above which you have to be in order to be granted credit, or maybe a sliding scale where the amount of credit you're granted is related to the level of your FICO score. Higher score, grant more credit; lower score, grant less credit. And then there's still probably some sort of level below which you would not grant credit at all. So when we want to evaluate whether we're getting a positive MPV for a one-time sale, we can look at a formula such as this. We're going to, and it's very similar to what we were just looking at, with a slight variation. So here we have the variable costs. This is basically what it costs us to produce the product. Pi right here represents the amount of bad debts in decimal form. So in this particular example, we're assuming a 15% default rate, which is really pretty high. I don't think I'd be engaging in one like this in the real world, but this is the example. So there's 0.15 there. P is the price that we sell this item for. So 1 minus pi times P is the total revenue that we're bringing in. And then R is our discount rate. And in this case, on a monthly basis, that's 1% because we're evaluating this project on a monthly basis. The credit is only extended for 1 month. And so when we put all the numbers together, we end up with a positive 42.56 monthly. And so obviously that's a project that we want to engage in. So another way to approach this is, rather than look at the MPV, we could figure out how high the default rate could go before we start losing money on this. In other words, before this becomes a negative MPV project. So we could set our NPV equal to 0 over here on this side, and then solve, actually, instead of for MPV, we're solving now for pi. And when we do that, we see that we could actually have default rate over half of the customer's default, and we still end up okay. Or if half of them did, we'd still have a positive MPV project. Obviously not the kind of model, though, that we want to walk into, because that's such a high risk. Credit analysis would easily allow us to drive that way back down into single digits at the very highest. But this is how we would figure out at what point we'd be in trouble with this project. Hopefully these numbers are not something you'd actually see in the real world. Now, when we consider a repeat customer, now here, in fact, in this particular case, we're assuming this customer buys this product from us every month. How do we figure out the value of that? Obviously, that's much higher. So if we still have the variable cost here of 50. We still have the default rate of pi, and then now here we're looking at the price minus the variable costs, and then this is still R. When we plug in numbers similar to what we were looking at in the previous example, you see that we actually get a considerably higher figure here. Now, you can think of this whole piece of the formula right here. This, again, is like that perpetuity. So when you consider that here we're looking at what 60 times 1 minus 0.15 divided by 0.01, you can see why that is such a high figure when we actually do the math. And so repeat customers are even more valuable and even a better reason to grant credit, especially if you think they will continue to pay, obviously, and come back and buy our product month after month after month. And another rule you could implement here would be, you give that customer one time. If they don't pay, you stop granting them credit, or even in the future, if they stop paying, all of a sudden you withdraw credit, and then you don't lose too much. So think of this as an iterative game. In finance, we talk about a real option. A real option means we alter our behavior at some point in the future. Most of the times we think of real options in the context of big projects where we start a project with a small investment, and in the future we can either completely withdraw that project, say we're trying to expand into another country, but we don't know. So we start with a small footprint, and then if things work out, then we expand that footprint. If things don't work out, then we withdraw from the country. So same thing is true here. We grant credit to a customer, and as long as they continue to be, pay their bills on time and continue to be a customer, things are great. The moment they stop, all of a sudden we withdraw that credit. In terms of credit information, comes from a variety of sources, from financial statements, and we're talking here particularly credit about a business. And obviously, in some cases, these are privately held businesses. They're reticent to reveal that information, but if they want credit, I mean, that's their choice. I mean, obviously, this is not information that you would be allowed to share anywhere, but as long as they're not competitors in the marketplace, presumably they'd be willing to grant you access to the basic financials. Credit reports are another way of getting this. So credit reporting agencies, a variety of them out there. You can get various scores from them. Banks are another good source. And then just the current payment history. I mean, are they always paying? Have they missed occasionally here and there? Things of that nature are helpful in determining our credit analysis. And then these 5 C's that we mentioned earlier, this would be character, capacity, capital, collateral, and conditions. So character is a very nebulous, subjective thing, right? Does it appear that these companies are willing to pay, have the capacity to pay? Capital, do they have money in reserve? What's their bank account balance look like? What's their checking account balance look like? Do they have marketable securities? Is their liquidity situation good? Collateral, do they have assets to pledge, right? I mean, if we're talking about a very big project, maybe there's some assets involved that could serve as collateral. That's a very good way to grant credit. Now, obviously, we don't want to have to own that asset, but ultimately, at least it minimizes our potential for loss and could certainly lower the interest costs. And then finally, conditions. And conditions are like general overall market conditions. Obviously, rates change on a daily basis, and as we've seen in the most recent period here, rates can go up quite quickly as the Fed attempts to tamp down inflation. So we've seen quite a drastic increase lately, and that probably has resulted in some retraction in terms of credit. And that's actually quite the point of the Fed, right? If we retract credit, we stop some of the spending lower, or orders lower, and that means that presumably price should drop as well, as there's less competition for a limited number of items. But those are the 5 C's of credit analysis. And then collection policy is the last topic in this section. And that's obviously an important area. You want to keep an eye on that ACP, that is the average collection period. Um, is it starting to creep up there? I mean, if you've got net 30 days and you've got an average collection period pushing out towards 60 days, that's not a good situation to be in. If you're at 31 or 32, 33 days, that's probably just a mailing issue or somebody trying to grab an extra couple of days. Also, you want to look at aging schedules. So what percent of your credit customers are on time versus 1 month overdue versus 2 month overdue versus 3 months overdue. And obviously, as we go further and further out, you want those percentages to drop really, really quickly. If they're not, or if the 2 month and 3 months are climbing, that's an alarming statistic, and it's something that you want to start contending with. Maybe reanalyzing how you grant credit and who you're granting it to. In terms of collection, that gets very expensive. You can start off just with a letter, telephone calls, but the more drastic measures are to turn very old receivables over to a collection agency at a very deep, deep, deep discount, right? You're going to get pennies on the dollar, but at least you get pennies, right? And then leave it to the collection agency to deal with it. If there's a single item, a single company that owes you a large sum of money, then certainly legal actions. But again, that gets extraordinarily expensive. You've got to have all your I's dotted and your T's crossed to make sure that you prevail in any sort of legal proceedings. Now we'll look at inventory management, another very important aspect of managing our short-term assets. Remember, both of these, the credit management, which is really accounts receivable, and inventory, both of those items are current assets, meaning that they have a short-term life, a life of less than a year. Inventory can take up a large fraction of the overall asset base. It usually is. Accounts receivable usually follow that, and then followed by cash. But you want to try to minimize that amount of inventory, but you don't want to get it to the point where if there are supply chain interruptions, that all of a sudden your production line screeches to a halt. And again, we've got an example of that happening during COVID, where normal order times were not only not possible, but sometimes it wasn't even possible to get an item, period, full stop, or it was months out. There were, the classic example of automobile manufacturers who couldn't get chips, and they couldn't ship the cars without the chips, and so they had cars building up on their storage lots, and that is part of inventory, right? Finished goods, until they're sold, are counted as part of inventory. So is work in process or work in progress, whichever term you want to use, same thing. But anything that's out on the production line that hasn't been finished and sold is part of inventory. So don't just think of it as raw materials that are sitting in the stockroom waiting to be used. It's that plus the work in progress plus any finished goods that are in storage or in inventory and have yet to be sold. And again, we're going to be looking at this same sort of optimal trade-off situation with the inventory management as we looked at with the credit. I already mentioned, raw materials, works in progress, and finished goods, all part of the inventory base. Carrying costs range from 20 to 40% of inventory value per year. That's a pretty big number. So you've got storage and tracking. You have insurance and taxes. You have losses due to obsolescence or deterioration or theft. Obsolescence, particularly if you're in some sort of tech industry, you've got chips. If those chips become dated, they lose value very quickly. If it's a material that it deteriorates with age, Sometimes they become unusable. Theft happens at the best of companies, and it could be theft from employees, it could be theft from outside, but nonetheless, that costs money. And then the opportunity cost of capital comes in here too, and that basically is just saying, hey, we're deploying this capital as inventory, but what else could we have used it for? That's costly. We need to raise these funds, and we have to support those funds with either equity or debt, and we have to pay the bondholders or the stockholders something for that. They are expecting a return. Shortage costs. Now this is the other side of it, right? We've got shortage costs such as restocking. So when we run out of an item or when we get a new order in, we've got to receive it. We've got to log it into the inventory and so forth. And that's cost time, cost employee time, and we have to track it. We also have the potential that if we run out of something, and we can't provide the customer with what the product that they're looking for because we're out of a particular item, then we lose that sale, and we may lose that customer too. If they're a repeat customer, they may go over to the competitors. All right, so we're trying to minimize both these costs, and we do so with this idea of let me jump straight to it. Let me share this with you first. So here again, just as with the credit management, we're looking at carrying costs, which are increasing in the optimal order level each time we order new items. This is the optimal size of that order. We don't want to order enough for 5 years, but we don't want to order just enough for 5 days, right? Some spot in between there. Now, carrying costs are increasing in that. So as we increase the size of the order, of each order that we do, that means we have a higher average inventory of that item, and that means there are higher carrying costs. So that's all of those, that's all of these items right here, right? Storage, insurance, losses, and opportunity costs. And then in terms of shortage costs, restocking costs are here. Now, they don't necessarily, in this one, we're not talking about loss of sales, but that would actually exacerbate this. Certainly, if we make the order size very small, keep the inventory levels down very low, we have a much greater chance of running out of an item and not being able to actually satisfy a customer order. All right, so where these two cross right here, that is our minimum, and that's where we want to be. And we've got a model here, this EOQ model, that helps us to figure that out, but I'll come back to that. Okay, so how do we minimize the cost of inventory? Well, 3 different approaches. These aren't necessarily mutually exclusive, but this ABC approach, for instance, we categorize items into categories A, B, or C. A category items have high profitability or high volume. B are moderate in both cases, and C are low. So the A items, we want to make sure that we have plenty of those in inventory. The C items, we can keep much lower levels on without fear of causing us to have shortages or stock out situations with customers. This EOQ model actually does that looks at those 2 cost curves. One, the carrying costs going up in order quantity and the restocking costs going down in order quantity, and we find that equilibrium where the 2 equal one another. And then there's several derived demand management techniques, and we'll talk about those in just a minute. So the EOQ model is helping us to find the minimum total cost, which is where the total carrying costs and the total restocking costs are equal to one another. And that is when we calculate the carrying costs, it's the average inventory, which we take a beginning period and an ending period level and divide by 2. That's what this Q over 2 is. And then CC right here just represents the carrying costs on a per unit basis. Okay, not total, but per unit basis. Restocking relates to the cost related to buying the item. So we've got a purchasing agent that's got to make the call to the supplier. Supplier has to agree to ship it and invoice us. Then we've got to receive it, and we've got to put it into inventory and track it and insure it and so forth. So the restocking are fixed costs per order times the number of orders that we would have in a given year. So total costs are the sum of the carrying costs and the restocking costs. And so we have carrying costs, and here are restocking costs. And now what we can do is we can do a little mathematics, a little algebra, and we can solve for the optimal quantity ordered per order. That's what this Q star represents. What size should we order every period? And obviously the size of the order, we could divide the total demand for this item on an annual basis by the size of each order, and that will tell us how frequently we need to order. But I think an example would be easiest to demonstrate this. All right, so here we have carrying costs on an item are $1.50 per unit. Total fixed costs per order is $50, and the firm expects to sell 100,000 of these products that include this item in a given year. So here we have 2, which is a integer, and then we have the total sales multiplied by the fixed costs to place an order, and then here are the unit costs. And when we do the math, we find that our Q star is 2,582. So we would order 2,582 units every period. Now, how many periods is that? Well, it's 100,000 units that we need divided by 2,582. And let's see, let me grab my calculator here. And that gives us, divided by 2,582, I get 38.72 periods. And that's per year. So I will take my 38.72, I'm going to divide 365 by 38.72, and that means that approximately every 9.5 days we're going to be ordering these items. Now, as fixed costs per order go up, we're going to extend that period. As carrying costs per unit go up, we're going to shorten that period. But that just gives you an example of how this economic order quantity method would work. We're optimizing by lowering the total costs here. Couple of things you have to take into account. This EOQ method is a little bit more in depth than the chapter and that we're going to be able to cover here in this class. But there are a couple of items that are very important to keep in mind. We can't let the stock go to 0 before we order, right? So we have to find out, where do we reorder, right? If it takes 2 days to place the order and then receive it, then we need to order 2 days before we absolutely need it. So that's something to consider. And then maybe we don't want to let the stock go all the way to 0 to begin with. We want some sort of safety stock, some sort of minimum always on the shelf no matter what. And the reason we would do this is suppose there was a delay in the order. Maybe they couldn't ship the entire order at the same time. Maybe we miscounted. Maybe there was some sort of computer error in the tracking, the inventory level. Uh, there we want safety stock. And the reason I mentioned earlier about these other methods, this ABC method could come into play here. The A category materials, we would probably have a very high level of safety stock. The C category, we would have a much lower level of safety. So we can kind of integrate these methods and use them together. And then finally, this derived demand inventories, a couple of methods here. One is called MRP, Materials Requirements Planning. Basically, you look at the holistic system. And again, just as with the EOQ, we're not going to go into a great deal of detail on this at this level. This is really a general overview of corporate finance and financial management. But that will give us a better idea of when we need to, where we might be able to minimize maybe our holding period on this. Do we have a lot of work in process that we might be able to minimize somehow? Could we install it at a later point if we have an assembly line? How do we minimize the amount of finished goods product that we have to inventory and carry without losing customers by having stock outs and that sort of thing? And then another method that certainly in recent years has lost some favor, and that is this thing called just-in-time inventory management. And the idea is we want to cut it right to the bare minimum, and maybe we don't have any safety stock, and we're just expecting, we need the item tomorrow. Our stock level today is 0, and we take delivery of it tonight. Again, as I said, this used to be popular about 20 years ago. It was originated in Japan and spread worldwide. And when I was an MBA student, it was kind of the latest, greatest thing, minimizing your cost by really cutting it close. But now, going through COVID, we've seen that, having some sort of safety stock is probably a smart thing to do, even if you think you've got a good supply chain. When bad things happen, those supply chains break down quicker than we could ever have imagined. And that's about it for the chapter. And have a good evening. Bye-bye.